Another day of Powell testimony, another message about incoming rate cuts, only this time the markets like it. That's the bottom line that we take away from Wall Street price action today. Yesterday, the markets feeling a little bit circumspect as the Fed chair strikes a dovish tone, uncharacteristically, relative to recent months, says the balance between inflation and employment is getting closer. Now we're starting to think maybe we don't want to unduly over-tighten, and creates a level of immediacy around when rate cuts would come. And the markets, not surprisingly, look at this and say, so you're saying something is about to be as negative about the trajectory of growth as is necessary to spur you into action. Well, that's not like speculating about rate cuts 3 months ahead. That's immediate, and we don't like that. That means something is about to be negative about the business cycle. But today, that perspective is much cheerier. So the question now that we ask ourselves is, how is this cheer going to hold up to economic data scrutiny? Because, of course, now that we've gotten our guidance, now that the Fed chair has given us our marching orders, we get an immediate stress test in the most direct and acute way possible with the release of U.S. inflation data. And this will be the first of the sort of critical tests as to just how comfortable are markets with the idea that rate cuts are now imminent on the horizon. Now, of course, a bit of stage setting here. First, needless to say, over the past 3 months or so, the markets have reveled in the expansion of rate cut expectations, and in particular, the swelling in how much easing is expected next year. The Fed started us off with relatively confident rhetoric at the beginning of 2024, saying we're going to deliver 3 rate cuts this year. Then inflation stalled. And we heard as the Fed going into the end of the second half, in particular in May and June, started to sound frustrated, saying we're not going to be able to cut as much. We saw them officially revise their forecasts at the June policy meeting because inflation is not confidently progressing downward in the direction of our 2% target at the pace that we would like to see it doing that. And the markets seem to look at the Fed's reticence and say, right, so you're not going to have the confidence to cut any more than once, but you really should be cutting. And so because you are going to delay, you're going to have to give us a degree of catch-up next year. You're going to end up behind the ball. You're going to end up cutting later than you should to engineer a soft landing for the economy. And because you're going to miss the boat, you're going to have to go faster in 2025 and to a greater extent. So what we see over the past 3 months is the markets go in mid-April or so from 76 basis points baked in over this year and next, implying 1 cut this year, 2 cuts next year, to holding it at 1 cut, give or take, for this year, a few basis points this way or that. You can see in the gray bars here is the outlook for 2024, and it's been basically unchanged for 3 months' time. But the cost of this holdup is that the outlook for 2025 starts becoming increasingly dovish, and we can see this yellow area expands, where the outlook nearly doubles and goes from 3 cuts now to 5, with a consideration perhaps of a 6th. Now, of course, the likelihood of that 6th cut still very low, but needless to say, from 76 basis points to 132, is a dramatically dovish shift. And of course, the markets have enjoyed this. We can see here that as we've seen the push down in the cumulative rate cut outlook, so too stocks bottomed and moved higher in near perfect inverse. In fact, we can tag it even along the way with the turning points that we see in markets. When this stalled, stocks stalled. When this got a little bit less dovish, stocks wobbled a bit, so on and so forth. So the markets have cheered the prospect of more rate cuts down the road. But what about the immediate outlook? Well, there's only one meeting between now and September, and that is, of course, at the end of this very month on July 31st. Markets overwhelmingly think the Fed will not cut rates at this meeting. The pricing in Fed funds futures here, 95% likelihood that we're going to remain on hold at the current setting. Things change very quickly when you get to the aggregate likelihood of a cut in September, the very next meeting. Now you're almost 80% likely to see the cut. In other words, the markets have now set themselves up to say, not only are we going to get the cuts, but they are immediately on the horizon. And this is the lens through which we now look at this incoming inflation data. The expectation is that we are going to head a little bit lower on the headline number, down to 3.1% year on year. That would bring us in line with the range that's held here for essentially most of the year as this issue with energy has been digested. We can see here energy, of course, a big source of inflation 2021 into 2022. As we rebased, it actually became a very significant negative influence on inflation, pulling it lower. That has since rebased, and through the process of this rebasing, we can see the bottom in inflation is where energy was at its most negative contribution. As this has rebased, so too inflation has stalled. But of course, we can see that at this point, energy is a negligible contributor. Goods are actually a negative contributor at this point, implying softness in demand starting to percolate, perhaps. Food is squeezed down to a very modest sort of influence. And clearly, all of what is left, or almost all of what is left in sticky inflation, is living in the service sector, which puts the onus on the core number. That's this right here. And the core number here is really, in stripping away energy and food, reflecting almost exactly what's going on in that service component, because, of course, the goods side is a blip. And here we're expected to hold unchanged at 3.4%. Now, that number set in May was a 3-year low. So all in all, this is shaping up to be a relatively benign report. Except U.S. economic data has been increasingly underperforming relative to forecasts, according to data from Citigroup. And indeed, we can see how this lines up with Fed policy expectations. So here we are, mid-April is where the sort of push through zero on this index and a real kind of a pivot to see U.S. economic data start to meaningfully and in a lasting way underperform relative to forecasts. That is, not just beating expectations by a narrower margin, like what we saw, for example, here, the episode from July 2023 through January of 2024. But now actually slipping through the zero line on this index, which implies now data is starting to actually tend toward weaker outcomes. Well, that this turn is starting here in mid-April is, of course, very telling, because that's right here. This is the place where investors go, the Fed is delaying, but the economy is deteriorating. Okay, they'll need to cut more because they're stalling. And what this means when the economy is deteriorating is they'll need to do more, and they'll need to do it faster once they start to do it. So the question now is, are we going to get, in the context of what's been going on here, a disappointing set of CPI numbers? And if we do, what would that mean? If this were a disappointingly soft set of CPI numbers, and disappointing surely is in quotes because that is a matter of perspective, lower inflation would be easier on consumers. It would also encourage the Federal Reserve to think that what they're doing is working. But if the number were lower than expected, and this was 3 months ago, well, then the conversation would surely be that of great optimism, because rate cuts would be somewhere on the horizon. This would endorse them. Maybe we get more rate cuts because the number is weak. Surely a positive catalyst for stock markets, a positive catalyst for yields, perhaps, or for bonds rather, and surely something negative for the U.S. dollar. But now the situation has grown much more urgent, because now the rate cuts are just through one meeting away. Now, if you get a weaker CPI number, and it's weak enough that the markets have to think, wait, inflation is falling really quickly. Is it possible that July isn't as skewed as it looks here? Is it possible that the Fed might actually need to move as soon as this month? And if that were the case, are we facing a growth emergency that is already in front of us? Is the Fed already behind the ball? Is the economy already flirting with recession, and the Fed needs to act right away? Now, what would a miss like that look like in the context of this? Well, we get a bit of an example of what a dramatic miss might look like on the latest set of ISM economic activity surveys, where the results were plainly shocking. Now, it wasn't so shocking that the manufacturing side of the equation was a little bit weaker than anticipated. The expectation, as we can see here, was that the manufacturing sector would continue to contract in June. Indeed, it did. It contracted at a slightly faster rate than anticipated, but modestly so, 48.5 versus 49 expected. Again, this is in the logic of PMI diffusion indexes. So 50 is neutral, neither growth nor expansion. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. The real shock here was on the service side. And of course, as we just said, inflation is stuck in the service sector. Not only did we not grow at a healthy 52.5 clip that was expected, we slumped back under 50 and saw the service sector shrinking, and shrinking at the fastest rate since back here, December of last year. And so, or December 2022 rather. So what we're watching here is a very abrupt, very sudden turn toward contraction for U.S. economic growth that the ISM data implies occurred in June. In fact, the Atlanta Fed's GDP Now estimate of the latest figures suddenly took a level step lower as we got the latest set of numbers and jumped from 3%, overshot a little, but now seems to be a full percentage point lower than the numbers had been signaling, implying that maybe we do have a hard break that got pulled here in June, or at least a hard enough one that a big miss on CPI is in the cards. This, of course, would come at a most inconvenient time for risk sentiment, because the flow of economic data has not only been deteriorating out of the US, in fact, it's been deteriorating all around. In the red here, we see the G10 economies, the major economies. In the blue, a global average. In the green, emerging markets. For emerging markets, we see that although there's been deterioration, and that deterioration began with some lag after where the global and the major market indexes crested here in April or so, although this has had a little bit more run and seemed to top out later toward the beginning of May, it is nevertheless showing that data is beating by ever reduced margins. Whereas what we're seeing for the global index and for the major market indexes, not the least because of what's going on in the US, as we just saw since April, that would be this right here, but also because the situation in Europe is becoming once again more dire. There was a bit of a catch-up. They had a shallow recession at the end of last year, and there was a bit of a catch-up in the front half of this year. But as we can see since May, that has really started to get wobbly. And of course, the latest PMI numbers out of the Euro area, which we looked at yesterday, and we'll put a link to that video up here above my head if you're watching on YouTube. Those numbers came out about as shockingly weak, or similar to as shockingly weak as what we just saw for the US ISM data. And that, of course, doesn't bode well. Because when we look at the overall trajectory that is developing here, it isn't just looking like the US economy might be seeing inflation fall faster than expected, or it's only the US economy that's hitting the skids. This is increasingly starting to look like the resurrection of global recession risk. And indeed, if we look at the makeup of global GDP, this is an estimate from the World Bank, we've been standing on the precipice for quite a while because the US has been, to a large extent, the only game in town as far as growth for the better part of a year, maybe a year and a half. We just got data out of China this week, just yesterday, as a matter of fact. And as we expected here on macro money, it undershot expectations, lower CPI than anticipated, signaling that demand in the world's second largest economy remains woefully anemic. As we've just mentioned, the situation in the Eurozone seems to be taking a turn for the worse. That catch-up in growth that we saw after that shallow recession through some of the first half of the year, mainly the first quarter, seems to be unraveling. That's the second engine of global growth. Now, of course, China has been anemic now all through the post-COVID period, and the Eurozone, barring that little upswing to catch up from a recession, has remained on the mat as well. That's meant that robust U.S. economic growth has really been the only game in town, and largely remains so as we get into this year. If that is finally changing, then the world economy is left without an engine to power it forward. And if the CPI data suggests that indeed that is what we're looking at, well, then one starts to wonder how a global recession is escapable at all. Because if three of the major economies that account for 50% of global GDP are all misfiring, and if the remaining 50 are largely vendors to the former three that depend on these three for demand, think of Canada and Mexico and the US, or Central and Eastern Europe, or even Nordic Europe and the UK in the Eurozone. Think Southeast Asia, much of Africa, some of Latin America. Think Australia, New Zealand, when it comes to China. If all of these three are misfiring at the same time, and the rest depend on them to have demand so that there is vendor demand from there emanating out, well, then there is no safety net if the U.S. stumbles. And with stocks at record highs, that sounds like a compelling reason, perhaps, to lighten up. So although the trend has been for inflation that is weaker to be a supportive thing for markets, we may just be getting close enough to the beginning of the rate cut cycle where that dynamic flips, especially if the data meaningfully underperforms expectations. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things might go thereafter. I'm back with Victor Jones tonight for The Price of Truth, just 30 minutes after we wrap here. Back on with Chris for Futures Power Hour on Friday, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Price of Truth is in 30 minutes. Macro Money is back tomorrow. Good luck out there.